Hello and welcome back to Hank USA. I'm Hank. Today, let's talk about something that's causing a lot of worry right now. Lately, you might have seen alarming posts on social media, especially on Facebook, with claims that the IRS has suddenly started fining seniors for all sorts of everyday transactions. These posts talk about penalties for sending money to your grandchildren, for selling a few things online, or for practically any money that moves through your bank account. For many people, these warnings are genuinely frightening. The thought of an unexpected letter from the IRS is enough to cause sleepless nights. Today, we're going to cut through all that noise and confusion. We will go through the actual, current rules as of 2026, breaking it down situation by situation so you have a clear understanding of the facts. And please, stay with me until the very end of this video. There is one specific, common situation where things can actually go very wrong, and most people have absolutely no idea it's a problem until it's far too late and the notice has already arrived. I want to make sure you know how to avoid that trap. Before we dive in, if you want to stay ahead of these constant changes and get accurate, up-to-date information you can trust, please take a moment to subscribe to Hank USA right now and turn on the notification bell. So much of the scary information circulating online is based on old rules. Rules that were proposed, then delayed, and in many cases, completely reversed. The people who are subscribed here get the correct, current picture. So, go ahead and click subscribe, and let's get into the details. First, let's establish what actually did and did not change in 2026 so you can understand the real landscape. For several years, there was a highly debated new rule that was set to take effect. This rule would have required payment apps like Venmo, PayPal, and Cash App to report almost any payment over a tiny $600 threshold directly to the IRS. This would have included personal transfers, like paying back a friend for dinner or sending a birthday gift to family. That proposal, as you can imagine, caused enormous confusion and widespread panic. The good news, and the most important thing to know, is that this rule was permanently repealed. A major bill, which was signed into law back in July of 2025, completely did away with that plan and restored the original, much higher threshold. So, as of today, here are the current federal rules for those payment apps. Venmo and PayPal are only required to send you and the IRS a Form 1099-K under two specific conditions, and you must meet both of them. First, you must receive more than $20,000 in payments for goods and services. Second, you must have more than 200 separate transactions for those goods and services within a single year. It's critical to understand that personal transfers, when they are correctly tagged as being between friends and family, are completely excluded from this rule. There is no reporting for these personal transfers, no matter the dollar amount. Now, what about Zelle? Zelle operates in an even simpler category. Because Zelle facilitates transfers directly from one bank account to another, rather than holding the funds itself like PayPal does, it is not classified by the IRS as a, quote, third-party settlement organization. This is a key distinction. As a result, Zelle never issues a 1099-K for any amount of personal transfers. And for those of you who don't use any of these apps and prefer to simply transfer money directly through your bank, using wire transfers, ACH transfers, or your bank's online bill pay service, the rules are just as straightforward. The IRS does not have automatic, real-time access to your individual bank account transactions. Your bank, of course, maintains detailed records, and those records can be legally subpoenaed if the IRS has a specific and valid reason to launch an investigation into someone's finances. However, routine family money transfers do not trigger any kind of automatic reporting to the IRS, regardless of the method you use or the amount you send. With that foundation in place, let's walk through the 5 most common situations that cause seniors to worry. Situation number 1. You send money to your grandchildren or your adult children. Maybe it's to help with their rent, for school expenses, to cover groceries, or just as a birthday gift. It could be a few $100s each month, or perhaps a larger one-time amount. Whether you send this money through your bank, via Zelle, on Venmo, or by writing a traditional paper check, a big question arises. Is this transaction taxable? Do you, as the sender, need to report it to the IRS? The answer is a clear and simple no. Transfers to family members that are intended as support or as gifts are not considered taxable income for the person who receives the money. Likewise, for you, the giver, it is not a deductible expense. There is absolutely no reporting requirement for either party in these everyday situations. If you're using an app like Venmo, just be sure to tag the payment as friends and family, and it will be completely excluded from any business-related reporting. If you do it through your bank, it's just an ordinary outgoing transfer with no tax consequences. The one number that is worth knowing in this context is the annual gift tax exclusion. For 2026, that amount is $19,000 per person per year. This means you can give up to $19,000 to any single individual within one calendar year without any tax paperwork. If you do give a single person more than $19,000 in 1 year, you may be required to file a form called Form 709. But it's very important to understand that filing this form does not mean you suddenly owe tax on that gift. It is simply an informational form that notifies the IRS, and the amount given above the annual exclusion is counted against your lifetime gift and estate tax exemption. That lifetime exemption is currently a staggering $15 million per person as of 2026. So, for the vast majority of seniors sending typical amounts of money to help their family, this is simply not a relevant concern. Situation number 2. Let's flip the scenario. Your children send you money to help with your expenses. Perhaps they are helping you with your mortgage payment, your utility bills, unexpected medical costs, or just your everyday living expenses. Is this money considered taxable income to you? Do you have to report it on your tax return? Again, the answer is a firm no. Money that you receive from your children as family support is not taxable income. It does not negatively affect your Social Security benefits, and it does not push you into a higher tax bracket. You do not need to report it anywhere on your tax return. This rule applies no matter how the money arrives, whether it's through Zelle, a direct bank transfer, a check, or even cash. Situation number 3. You've recently sold a major asset, like your house or your car, and you want to transfer a portion of that money to your children. The amount is much larger than a typical gift, and you're worried that a large transfer might look suspicious to the bank or the IRS. Let's break this down. First, consider the tax implications of the sale itself. If you sold a home that you lived in as your primary residence for at least 2 of the last 5 years, federal law provides a very generous exclusion. You can exclude the first $250,000 of profit from capital gains tax if you're single, or a massive $500,000 of profit if you're married and file jointly. If your gain from the sale was within those limits, you owe no capital gains tax, and there's nothing extra to report beyond your normal tax return. For most other household assets, like a personal car or furniture, you almost certainly sold them for less than what you originally paid for them. This means you have a capital loss, not a gain, and therefore there is no taxable event at all. Once that money from the sale is legally yours, you are free to transfer it to your family members as a gift. The key here is good record keeping. Be sure to keep your real estate closing documents or the bill of sale for the car. If a question about the source of the funds were to ever come up, those documents provide the complete, clear story of where the money came from, proving it was not undeclared income. Situation number 4. You've been doing some spring cleaning and sold personal items online. Maybe you used Facebook Marketplace, eBay, or a local buy and sell group. You sold an old couch, a television you no longer need, some old tools, or clothing. You received payments for these items through Venmo or PayPal, and now you're worried because you have a lot of small transfers coming into your account. Here's the rule. Selling personal items that you already owned at a price that is lower than what you originally paid for them produces no taxable gain. There is nothing to report as income. For example, if you bought a television 5 years ago for $600 and you just sold it for $75, you have a loss of $525, not income. The vast majority of used household goods fall squarely into this category because they depreciate or lose value over time. However, there is a specific trap to watch for here, particularly on Venmo and PayPal. If a buyer accidentally marks their payment to you as being for goods and services instead of friends and family, that payment will now count toward your $20,000 and 200 transaction threshold for business reporting. This can happen even if the sale was completely personal and non-taxable. If this mistake happens across many transactions, it could inadvertently push you over the reporting threshold and trigger the platform to send you a 1099-K form. The best defense is to keep a simple record for anything you sell. Note what the item was, what you roughly paid for it, and what you received when you sold it. A simple note in a notebook or on your phone is perfectly sufficient. If you ever do receive a 1099-K form for these kinds of personal sales, remember that the form itself does not mean you owe tax. It simply means you must account for it. You report the gross proceeds on your tax return, and then you show that these were sales of personal items at a loss, which results in zero taxable income from them. Situation number 5. And please, pay close attention, because this is the one area where real problems can and do happen. If you regularly receive payments from people who are not your immediate family, and these payments are for services you provide, for rental income, or for goods you are selling as a business, that is considered taxable income. This is true regardless of how that money arrives in your account. Whether the payment comes through Zelle, a direct bank transfer, cash, or a check, the payment method does not change the fundamental tax treatment of the income. If you do any kind of side work, like tutoring, consulting, or handyman services, or you collect rent from a tenant, or you run any kind of small business activity from your home, that income must be reported on your tax return. The IRS can and does identify income that doesn't appear on a tax return through various methods. For example, they can analyze discrepancies between a person's reported income and their documented spending patterns, or large asset purchases. This is a process that does not require them to have access to any of your individual day-to-day transfers. The bottom line is, if it's income from work, it's taxable. Always keep accurate and separate records for any income you earn from work or business activities, and be sure to include it properly in your tax return. One final crucial note is on state-level rules. We've established that the federal reporting threshold for payment apps is $20,000 and 200 transactions. However, a handful of states have chosen to apply their own, much lower threshold. Massachusetts, Vermont, Maryland, Virginia, and Washington, D.C. all use a much lower $600 threshold. Additionally, Illinois and New Jersey use a $1,000 threshold. If you live in one of these specific states and you receive payments for goods and services through Venmo or PayPal, you may receive a state-level 1099-K form for a much lower amount than the federal rule. Again, this does not automatically mean you will owe state tax on that amount, especially if it was from selling personal items at a loss. But it does mean you must account for that form in your state tax filing. Please check your own state's tax department website for the most current rules. And as a general reminder, the information in this video is for educational purposes. Tax laws can be complex and are subject to change. It's always a good practice to verify current rules and thresholds on the official IRS website, or to consult with a qualified tax professional who can provide advice tailored to your personal situation. So, let's do a quick summary of what we've learned. The dreaded $600 federal reporting rule for personal transfers was permanently repealed. It is not the law. The current federal threshold for receiving a 1099-K from apps like Venmo and PayPal is over $20,000 in revenue and over 200 business transactions. Personal, friends, and family payments are completely excluded from this reporting. Zelle and direct bank transfers have no automatic IRS reporting mechanisms for personal use at all. Sending money to your grandchildren and receiving money from your adult children for support is not a taxable event for either party. Selling your used personal household items at a loss creates no taxable income, though you should keep simple records. The one real issue to be vigilant about is income you earn from services, rentals, or any other business activity. That income is always taxable, no matter how it's paid. The IRS is not on a campaign to fine seniors for sending birthday money to their grandkids. The alarming posts you are seeing on Facebook and elsewhere are overwhelmingly based on old, confusing rules that were proposed, widely panicked over, and then ultimately reversed before most of them ever fully went into effect. I hope this has brought you some clarity and peace of mind. This has been Hank with Hank USA. If this helped you, do me a favor. Hit that subscribe button, turn on the bell so you don't miss the next update, and share this video with a friend or family member you know who has been worried about this. Take care of yourself, and I'll see you in the next one.